Hello my fellow freedom builders and welcome back to the channel. Today we finally have a video about some automated investing. Lately there has been a lot of videos about the crisis and virus and all sorts of stuff, but today we're gonna dive into the toolbox and see if we can find some good valid tools that can help us getting a better performance. Now on the thumbnail to this video I set a 15+% sign in a screen. And that is not pure clickbait. What you're going to see today is a tool that can actually improve our investing, and we have some research to back it up. So if you stick to the end, I will show you exactly how you can implement this in your own investment style. But first of all, let's have a look at what we're going to do today. We're going to look at something called the Piotroski F-Score. And I know it sounds a bit strange, but Piotroski was I think he was a professor or something, an accountant, and in around year 2000 he tried to figure out a method to weed out all the bad companies, all the bad stocks from a fundamental point of view, so that he could focus on the best stocks. And I must say, and that's what I can read from his research, that the results in his backtest, they did beat his absolute best expectations, because they were astounding. And today we're going to have a look at if they still are, or if something has changed in the market. First of all, what is the Piotroski F-Score? It is a simple measurement of what is called fundamental momentum. So we're looking at some fundamentals, quite easy to quantify, and we are looking at some of them needs to be positive, but also some of them needs to have momentum, meaning that they should be getting better from year to year. There are 9 points, and each of them can be scored either 1 or 0. So you can get from a stock, you can get anywhere from 0 to 9 points. 9 being the best, 0 being the absolute worst. So what is Piotroski actually measuring? Well, the Piotroski F-Score is measuring profitability in a company, it's measuring debt or leverage, and is measuring efficiency. Profitability has a highest weight with 4 potential points, debt leverage has 3 potential points, and efficiency 2 potential points. Let's have a look at the 3 different parts here. So under the profitability, the Piotroski score measures return on assets. If that is positive, return on assets, you know, the ROA, when you look at the fundamentals, if that is positive, even though they are just making $1, it scores a 1 point here. If the cash flow return on assets are positive, well, they score another point. Then Piotroski looked at change in return on assets. If that was going up from 1 year to the next, it could score 1 point. And cash flow return on assets, if that was larger than the return on assets, it could score 1 point if that was the case. I know if some of you are new to all of the fundamental analysis, all of this might be sounding a bit strange and weird. I'll not go into depth with each of these single points, but because that would become quite a lengthy video. But if you have questions, please feel free to ask them in the comment section below. But what this actually measures is the company profitable, and is the profitability getting better and better from last year to this year. So that is actually kind of good thing to measure, and that is also what I normally do when I look at the fundamental momentum. I don't just want to look at a PE ratio or something like that, some static. I want to see if the numbers are getting better and better year over year. So let's have a look at the middle point here, the debt and leverage here. When we look at that, there are 3 potential points to be scored. First of all, Piotroski looked at change in gearing or leverage, meaning that if we were looking at the debt compared to the assets of the company, if that was getting lower, and that of course could be because they were lowering the debt, but also that they might have been able to enhance or inflate the total amount of assets without taking on any more debt. So if that ratio was getting better, meaning lower, they could score 1 point. Also looking at the current ratios, and the current ratios is where you're looking at the assets and the liabilities and compare them to each other. And if that is good, then we can score 1. And then change a number of shares. And in here, Piotroski was looking at if the company was issuing new shares or buying back some of their own shares. And that is these share buyback programs that has been a bit controversial and discussed lately with the big crisis, where a lot of the large companies, for instance some of the airlines, have been spending 95% of their profits buying back shares, and sometimes they have even taken on extra debt also to buy back their own shares. There's not really a problem with buying back shares if they're doing it with their own profit, with their own cash flow, and the management of the company is thinking that it would be the best place to put the money, that would be in their own company. Then it can be justified. But if they are buying up the number of shares here, the share buyback programs, it will actually become a 1-pointer here, because Piotroski sees that as a good thing. But of course, if they're using debt to do it, then it will show up in these 2 up here, and then they will probably score a 0 up here. But also a 0 down here would of course be if the company had to issue new shares because they were in lack of liquidity, they needed money, so they were issuing new shares and diluting the shares that the shareholders already had. So that is the debt or the leverage getting better, or is it getting worse? So what Piotroski is doing now is he's looking for a profitable company that is getting more and more profitable, and doing so with less and less leverage. So that is two key components here. The last one is the efficiency. And here is looking at the change in gross margin. That should become better. And that is where we're looking at the price compared to the cost, basically. Can the company take a larger and larger chunk of the sales and end it down on the bottom line? So if this one is getting better, it could mean that they can charge a larger price for the product. It could also mean that they have been cutting costs so that the gross margin is actually getting better. Also here, change in asset turnover. We're looking at if they can either increase their sales with the same amount of assets, or if they can kind of reduce their assets and have more sales. So we're looking at if the total amount of asset turnover is getting better. If so, they can score 1 point here. So that is potential 4 points, it is 3 points, and it is 2 points, and that equals 9 points altogether. So what the Piotroski score here is measuring is basically, do they earn money? Are they earning more money with less leverage? And are they getting more and more efficient? I hope that makes kind of sense, even though you might not be a fundamental analysis, that you understand the basic concepts here. Now the question is, of course, did it work? Did his backtest and his real life testing work? And I can give you a little spoiler here and saying, yes it did, at least in backtest, but there are a couple of caveats here that we need to address. But first of all, Piotroski tested 20 years of data from 1976 to 1996. And what he saw was that by buying only companies that scored the best, meaning 8 or 9 points, he actually outperformed the market from 1976 to 1996 by 13.4%. So I know he would have been buying a huge bunch of stocks here because he was testing a large universe, but just as a research here, when buying all of the stocks up that had 8 or 9 points in the Piotroski score test here, the F-score, he would have outperformed, over these 20 years, he would have outperformed the market by 13.4%. Now, another thing he also tested was, what if he also shorted? He bought the stocks that had 8 or 9 in Piotroski F-Score, but also at the same time shorted the companies with the lowest scores, meaning 0 or 1. Now that was even more astounding because that strategy led to an average yearly return of 23%, and not 23% just, but 23% better than the market. So I don't know about you, but personally I am not outperforming the market by 23% each and every year, but let's see if it is possible. Here are some summary of the backtest. You can see here that by if he had bought the low scores here, the low Piotroski scores, he would have underperformed the market by 9.6%, and by buying the high Piotroski scores, outperforming the market by 13.4%, and by the high and low, meaning going long the good stocks and short the bad stocks, he would have outperformed the market by 23%. Now this is theoretical and hypothetical, but it is quite amazing. Also, a little thing we should take away here is that what he saw, and just remember that this test ended in 1996, so we didn't have any dot-com crash, we didn't have a financial crisis in 2008, we didn't have the latest virus crisis here in 2020, but what he saw here was that it was the small companies that did absolutely best, small and medium companies. The larger companies, and I should address here that what he did was he took all of the companies, all the stocks on the US market, and pretty much divided it into 3 portions of stocks here. So even the small stocks, there would actually be some pretty large companies among them, but that's another story here. But we can see that in the small companies, the small stocks, by choosing a high Piotroski F-score, he outperformed the market by almost 18% here. And the high to low, where he also shorted the bad stocks, made 17% outperformance of the market. You can see in the medium companies here, only quote unquote outperforming by 8% and 17.3% where he both got long and short. And then in the large companies, he actually only made a 2% outperformance when choosing the good stocks here. And there are probably several reasons for that. First of all, the large companies are harder to keep momentum in the fundamentals on them. So if you have a multi-billion-dollar company, it is harder to improve all the ratios and do it without debt and so on than it is in a small flexible company. So of course there's something about that. And there's also the fact that the large companies are probably better analyzed, meaning that it is harder to find good value there, something that hasn't been addressed and hasn't been investigated thoroughly by the analysts. So, of course, the large companies will have a more efficient pricing than the small companies. I guess that is how it is. And we should also remember that 1996 where the test ended was pretty much where the internet were becoming the common thing, or at least in the beginning of that among private people. So this is from a time period where it was harder to dig up data. Just basically both for analysts and for private retail traders. So the time before the internet was probably a bit less efficient in the overall pricing, I guess. So what they are writing about here on the Quant Investing, I'll put a link to this website below. They have a very smart screener. You can use the link below. That is an affiliate link. If you choose to have some paid version there, I might be getting a cut of that just to have that clear. But the Quant Investing, there are a ton of free information in here. It's really a gold mine of information. So what he is addressing here, Tim from Quant Investing, is that even though that this important notice here, even though you're not even looking at the potential gains, then just by not choosing the companies with the Piotroski score of 0 or 1, simply by not choosing the worst companies, you would miss out on the companies that were underperforming the overall market for 20 years in a row. And what I'm often saying is that a big part of my results is actually not that I find all the stocks that goes up by 1,000%. It is that my method is good at staying out of the big losers. And here the Piotroski score can absolutely help us. Tim here also have a test here where they are combining the Piotroski score with a growth stock strategy here. And that is where I see some really good benefits with the Piotroski score. I'm not sure I personally would just put money into something scoring a high Piotroski score, but combining it with something you already do is actually quite effective. And here is some very nice results. And this is in an already established strategy, a growth stock strategy. And now this is where it gets extra interesting for me, because now we are testing, or this is actually the real numbers from 1999 to 2010. So now we have the dot-com bubble included here, and we have the financial crisis of 07-08 and a recovery in 09 here. So now we are getting some recent data where we have some really tough markets. And here we can see that if we choose the growth stocks here, I don't know the exact criteria for picking these growth stocks, but if we choose these growth stocks and choose the one with high Piotroski F-Score, then this is the outperformance every single year. So in 1999, that would have outperformed the market by 43%. And so on. The numbers are not quite as big all the years, but the mean is 10.7% here. And if you had chosen the same growth stock strategy, but only had chosen the stocks with a low Piotroski F-score, you would have underperformed the market every year except from 2005 here, 2005. All the other years it would have underperformed the overall market. So overall, an underperformance mean of 13.8%. And again, if you had chosen to take the high F-scores long and the low F-score short, you would have outperformed the overall market for these 12 years with 24.5%. That is quite amazing. And I know that in the later years, I haven't been able to find some Piotroski tests, but I will try to build it myself in the coming months here over the summer. So what I will do here is that I'll try to backtest it in recent years to see if it is still reliable, because there has been a shift. It is mentioned in the media a lot these days that there has been a shift towards more growth stocks and less value. The last couple of years, or actually the last 5 to 8 years, have been quite hard on pure value investing. And that is because the market has gone up so quickly without looking at the fundamentals as much as it used to do. So the analysts analyzing all the fundamentals, they have had a hard time finding stocks that outperform the market, and they have had a hard time finding value because everything has gone up so quickly that many of the good stocks were actually way overpriced, at least according to the normal models. So maybe Piotroski has had a hard time as well. I will be testing that, and you will be seeing more videos about that here. Now these are from the US market, and of course it is also important to see, does it work in other markets? And Tim here at Quant Investing has been testing it on the European market from 1999 to 2011 here. And we can see, I'll not go into depth with his results here. I'll do that in a later video, not to get this too long, this video. But what you can see here is actually pretty much the same picture. We can see that if we pick the 20% with the best Piotroski scores, we can see that they overall, over this period, are making a way higher performance than the overall market. I think the overall market went up something like 30% in this time period. And you can see here that it doesn't matter if you took the small cap, the mid cap, or the large cap stocks here, and took the best Piotroski scores, it would have significantly outperformed the market. In from 20 to 40%, the next quartile here, or quintile it must be, it's still outperformed, but you can see it's getting worse and worse as when we get further down. And if you took the worst down to 0 and 1 in Piotroski score, you would absolutely have been killed and underperformed the market. So that tells me that at least up to around 2011, 2012, the Piotroski score was a viable factor to consider. And as I said, what I will try to do is that I will try to build some paper trading strategies where I month on month will try to track these different strategies and try to see if they are still good to apply to a standard market. So you will definitely get to hear more about the Piotroski score, but also more about some of the other strategies that Tim has here on his website. As I said, there's a link below, so if you want to support me and you end up buying some of his screeners, they're not extremely pricey. I think they're actually quite fairly priced. Then I will probably get a little cut of that. So that is clear for all. That's it for today. As I said, or in the thumbnail in the beginning, it said 15% plus, and I hope you don't feel like that was too clickbaity or lying in any way, because what actually seems to be doing here with the Piotroski score is that it is possible to get some good, solid performance, even though you're not an expert in fundamental analysis. So I hope that you found some value on this. If you did, please consider to subscribe to the channel and hit that like button down there. That's all for now. I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.